Don't let the financial stress of year-end steal your holiday cheer. With December deadlines coming up for retirement savers, we've got important advice you need to know. Tonight, our special user's guide continues with Derrick Kinney, president of Derrick, Kinney & Associates, and Chris Cordaro, managing partner and chief investment officer for Atlantic. Chris, I'm going to start with you. No, Derrick, I'm going to start with you. I'll get to you in a minute, Chris. Derrick, big considerations this year. Right now, what are they, end of the year?
First of all, don't let the tax tail wag the tax dog. Just because the opportunity is there doesn't mean it's right for you as an investor. Let's look at if you want to make a charitable contribution, a practical way. Most people think, let's write a check for it. Take a highly appreciated stock, donate that stock or that mutual fund to that church, that organization, take the full tax write-off, they pay no tax, and you get the full benefit of it. That's one simple way. But also make sure you're maximizing your retirement plans right now.
Well, we're going to get to that right now. We're going to get to that right now with Chris. I think it's critical here that if you have some money to put to work, you shelter it in a way that it's not going to be eaten up by the tax man. Chris, what's the best way to do that?
Well, that's exactly right, Gerri. And really what you want to be paying attention to at year end is, do you qualify for a 401k or some other retirement plan, not an IRA, because that deadline is year end. The IRA, you can relax a little bit because your deadline there is April 15th of next year.
So, look, at the end of the day, you want to shelter as much income from the tax man as you can. That's exactly what we're talking about. So you can set aside some of that money, absolutely, in these retirement funds. Derrick, to you, as you look at the strategies that people can absolutely employ here, a lot of people worry about window dressing out there, a lot of mutual fund managers trying to make their funds look as best as they can. What do you say to that? What do you do about that?
It's up to the individual investor watching to make sure they know what their fees cost and how much money those fund managers are making to make sure they're getting the best return and the best bang for the buck. You can't just rely on other people to make these decisions for you. It's very important to pick funds you know are quality funds right now that invest in high quality companies, nothing speculative. Make sure it matches your goals, your risk tolerance, and you're comfortable with the ups and the downs. Read those prospectuses, as boring as they may be, but make sure it fits your risk tolerance. Just because it's right for this person may not be right for your personal situation.
Absolutely right. Absolutely right. And Chris, to you, window dressing. I got to tell you, these mutual fund managers, they know how to manipulate you. They manipulate their portfolios so they look really good at the end of the year. And meanwhile, you don't even know what happened mid-year. What do you say to that?
Well, I think if you're in a mutual fund that involves in window dressing, you should vote with your feet and just get out of the fund. Because all they're doing is they're causing you extra transaction fees, potentially really poor tax results, because they're realizing gains in order to get rid of securities that they don't want you seeing at the end of the year. So be smart, vote with your feet, get out.
Get out. Okay, Derrick, rebalancing. Is now a good time to rebalance?
Yeah, the temptation, Gerri, is always to ride that hot stock as long as you can. Yeah. What I find is diversification beats greed almost every single time. Right now, take those profits if you have them. Talk to a tax advisor, know what the tax impact is. But listen, Gerri, here's a practical way to do this. If you've got some debt, high interest credit cards, a car note, think about taking some of those gains. Let the market pay off some of that debt. Have something to show for it, or diversify the money into some safer places. The worst scenario is the market drops again, or there's volatility, and you lose all the gains you've had. It's like going on a diet, losing weight and gaining it all back again. Very, very frustrating.
Well, Chris, to you, I think people are looking at the last 2 days of trading and they're saying to themselves, what's next? They're worried, they're concerned. Normally there's a Santa Claus rally this time of year. I'm sure your clients are calling you. What are you telling them?
Well, what I'm telling them is that emerging markets are absolutely the cheapest asset class out there. They're selling at such low valuations that you might have to look different, stand out from the herd for a little while. But on the long term, I think you'll really be rewarded by investing in emerging markets. And just to, Gerri, tie it back to our retirement theme, do you think you've got an investment that's really going to rocket over the next year or the next 2 or 3 years? You really want to put that in your Roth IRA. Those are the assets that you want to grow tax-free, and that's what a Roth IRA does for you.
You pay the taxes up front, not afterwards. Absolutely right. Derrick, to you, what kind of mistakes do you see people make this time of year typically?
Well, the first thing is they take advantage of what they think are the tax benefits only to get burned by them. as we talked about, making sure you're funding your retirement accounts, but also making sure you're strategic about taxes. Let's say you own a business and you want to take advantage of a small business deduction. You may buy a piece of equipment just to get the tax break, but you realize, wait a minute, I can't afford this this piece of equipment anyway. So make sure that within your budget, you're taking advantage of the tax benefits and know what's best for your situation. But also think proactively for next year, maybe bunching some of your deductions together.
Good idea.
Can be a way. Talk to your tax advisor. Work with them very closely, especially right now. Things are so volatile and unpredictable. You want to be sure you're on the safe side.
So, Chris, before you go, if you're 70 and a half, it's time to tap that retirement fund, right?
It is. If you turn 70 and a half this year, you had better take a required minimum
before the end of the year.
Before the end of the year. So your time's running out, and the penalties are huge if you don't take it.
That's right. They are huge. I always forget about that. They're really nasty. You have to make sure you do that. So pay attention to that if you're 70 and a half. Otherwise, just keep investing and putting money away. Derrick and Chris, thanks for coming on the show tonight.
My pleasure. Thank you.
Thanks.